Okay, let's unpack this. When we talk about the artificial intelligence revolution, we spend a lot of time on the software companies, right? The ones training the models.
The services.
Exactly. But none of that happens without the actual silicon, the foundational hardware.
Right.
And today we're doing a deep dive on the company that, well, basically makes it all possible, the dominant manufacturer that fabricates the world's most advanced chips.
They're the engine room. It's that simple. The engine room for this entire AI megatrend.
So our mission today is to really get under the hood of this AI infrastructure powerhouse.
Precisely. We're going to move past the hype and look at their strategic position, their financial health, and where they're headed long term.
And we have a ton of material to go through. Earnings reports, tech roadmaps.
And geopolitical risk, which is a big one here. But the core theme is really trying to understand their competitive moat. Why do they have this near monopoly on the high-end stuff?
Let's start with the financials then, because the recent numbers for Q4 2025, they weren't just good.
No, they were historic.
I mean, they didn't just meet expectations, they absolutely crushed them.
Yeah.
Revenue came in at what, the equivalent of $33.7 billion?
33.73, yeah. Just phenomenal. Yeah. Comfortably beat consensus.
And the earnings per share, too. A huge beat. So why? What's the strategic reason for a beat of this magnitude right now?
Well, the key is what they're selling. This wasn't driven by, a cyclical demand for cheap, low-end chips. This was all about high-value, high-margin silicon.
The leading-edge stuff.
Exactly. The crucial metric, and you really have to focus on this, is the advanced node mix.
Okay.
In that fourth quarter, a stunning 77% of their total wafer revenue came from their most advanced nodes.
77%.
Yeah, we're talking 3 nanometer and 5 nanometer technology. This is revolutionary because that's where the highest margins are. That's the exclusive stuff.
So that number, 77%, it's not just high. It suggests they're basically operating in a fortress. They have pricing power because they're the only ones who can make this. Who's buying it all?
That's the smoking gun right there.
Yeah.
It confirms their central role in the AI build-out. The demand is it's unrelenting, and it's coming from their biggest clients.
It's
NVIDIA, SMD, and crucially, Apple. All these companies need the absolute best performance they can get, and right now, this manufacturer is the only one who can deliver that at scale.
And it doesn't sound like it's slowing down.
Not at all. Their forward guidance is, it's aggressively bullish. They're projecting full year 2026 revenue growth near 30%.
Wow.
And if you zoom in on that AI accelerator revenue, the real engine here, they're projecting a mid to high 50% compound annual growth rate, through 2029.
Okay, hold on. For anyone listening who doesn't live and breathe this stuff, can you just quickly break down what KGRU means?
Of course, yeah. KGRU, the compound annual growth rate, is just the average annual growth they expect for that specific business line over a set period.
So a projection in the high 50s for 4 years.
It tells you they expect to be the primary beneficiary of this whole multi-trillion-dollar AI build-out, not just a participant, the main one.
Incredible. But growth like that only works if you can stay profitable. We saw their gross margins expand to 62.3% with guidance for even higher. Are they sacrificing margins for this growth at all?
No, it's the complete opposite. Those margins signal incredible pricing power and just really high utilization of their 3 nanometer lines. And all that profit keeps their balance sheet just unassailable. I mean, they had $90 billion in cash at the end of Q3. It lets them pay dividends and, more importantly, reinvest like crazy.
Right. The CapEx budget, it's always huge. But what are we looking at this time?
What's fascinating here is the sheer scale and what it signals. For 2026, their capital expenditure is budgeted at a staggering $52 to $56 billion.
52 to 56 billion.
To put that in perspective, that's a jump of over 25% from what they spent in 2025.
Yeah.
And they're not spreading it around. 70 to 80% is earmarked specifically for advanced nodes like 2 nanometer.
So they're funding the new fabs in Arizona and Taiwan.
Exactly. This is a capital war, and they are just outspending everyone into the ground.
That level of spending leads right to the big question, doesn't it? Their moat. If Intel and Samsung also have deep pockets, how does this company keep its lead? Is there a risk they're just overspending?
That's a great question. And yes, there's always a risk, but the market sees this as a defensive necessity. It's the cost of maintaining that moat. And their advantage really comes down to 3 pillars that are just so deeply entrenched.
Okay.
First is simply technology leadership. It's not just having the tech, it's the scale and the yield. They're already dominating 3 nanometer, and now they're all in on 2 nanometer. This includes their own IP in these new nanosheet transistors. They call it the N2 process.
What exactly is a nanosheet transistor? For a listener, what does that leap actually mean?
Okay, think of it this way. Traditional chips use these little fins to control electricity, like a single vertical lane on a highway. Nanosheets are like building a multi-layered highway. You wrap the control gate completely around these channels. It gives you way more data flow and much better power control in the same space. It's a generational leap.
And they're leading that race.
They are. And what's really critical is that their 2-nanometer capacity using this N2 tech is already fully booked by major clients, even before mass production has started.
Fully booked already? That almost suggests their competitors have conceded this next generation.
It absolutely does. The second pillar is just raw market dominance. They have, what, a 72 to 74% market share in advanced nodes and about 60% of the entire foundry market.
Right.
But the third pillar, this might be the most important, high switching costs. It goes beyond just the chip. Their customers, NVIDIA, AMD, Apple, are critically dependent on them. NVIDIA, for instance, relies on them for over half its capacity through 2027. And that dependency is locked in by a unique technology called CoWoS.
CoWoS. It sounds like jargon, but from what I've read, it's a huge deal, a bottleneck for the whole AI industry. So what is it?
CoWoS stands for chip-on-wafer-on-substrate. In simple terms, it's their special proprietary way of packaging chips together.
Okay.
If the silicon wafer is the engine, CoWoS is how you build the final AI supercomputer chassis. It's how you stack multiple chips like GPUs and memory right on top of each other so they can talk at lightning speed.
And no one else can do it as well.
No one can match their scale and yield. For a client like NVIDIA to switch, they wouldn't just need a new fab, they need a whole new supply chain partner who could replicate years of CoWoS optimization.
Yeah.
It's a multi-year re-engineering nightmare. It's the ultimate sticky factor.
Here's where it gets really interesting. We saw reports recently confirming that this company actually surpassed Samsung in operating profit, all driven by this AI surge. That's tangible proof, right? It's not just a technical lead anymore, it's a financial one. Their strategy is just paying off better than their rivals.
It's a massive validation of their focus.
So let's shift to the market. How is Wall Street reacting to all this? I mean, the price action has been incredible. The stock surged 5% after earnings, breaking out to a new 52-week high. It's up, what, 60-something% in the last year?
59 to 66%, depending on when you measure. The market sentiment is it's unambiguously bullish. Quantitative scoring shows a strongly bullish average.
And the big money is moving in.
Yes, the institutional accumulation is key. We saw one major fund, Liberty One, increase their stake by over 360%. The big money managers are betting this story has a long way to run.
We see technical terms like RSI and MACD thrown around. For the average investor, what does it mean that the stock is trading above its key moving averages like this?
It's just a way of measuring momentum and health. When a stock is above those averages, it signals sustained long-term buyer interest. The RSI and MACD patterns are basically telling us the recent surge isn't just speculative froth, it's built on fundamental strength.
So the rally has legs.
All the technicals point toward continued momentum, especially as we head into these big production ramps next year.
Which brings us to catalysts. What should we be watching for through 2026?
Okay, so on the immediate front, we have the acceleration of that 2-nanometer, that N2 high-volume ramp.
Yeah.
That's the big one. And we'll also see the start of tool installation at their Arizona Fab 2.
Turning CapEx into revenue.
Exactly. And then you have the huge macro tailwinds, the AI infrastructure spending megatrend that's projected to be $3 to $4 trillion by 2030. They're selling the shovels in that gold rush.
And the U.S.-Taiwan deal helps.
Hugely. It secures their expansion plans, and it really reduces some of that geopolitical tariff risk by diversifying their supply chain.
So what does this all mean when we get to the risks? Because the geopolitical situation with Taiwan is the elephant in the room. And valuation is always a concern when a stock runs this hard.
Geopolitics is absolutely the central bear case. Tensions with China are a real threat to their Taiwan-based production, which is still the core of their operation.
Right.
And as you mentioned before, building these overseas fabs in Arizona might dilute their margins by, say, 2 to 4% at first. They're just more expensive to run.
Is that risk priced in, though?
I think the market has heavily internalized it. The diversification through the U.S. deal and the Arizona expansion really mitigates the supply chain risk. And that initial margin dilution, it's going to be offset by two things in 2026. Improving utilization rates in Arizona and the full profitability of their 3-nanometer process, which will be at peak efficiency.
Okay, and the valuation check. A 27 times forward PE. Is that actually a good price for 30% growth, or is it still expensive?
That's the right question. If you look backward at the trailing PE of 34, it looks a bit rich. But when you look forward, based on that confirmed 30% growth, that 27x forward PE is actually a discount relative to their growth and their monopolistic position. They're growing into their valuation very, very quickly.
So that brings us to the final thesis. When you connect all the dots, the tech moat with N2 and CoWoS, the massive $50+ billion capex plan, the 30% growth, the institutional buying the picture is overwhelmingly clear.
It is.
This is an AI monopoly driving hypergrowth with sustained high margins. We see this as a multi-year hold, really targeting that 2026 AI supercycle. We're holding a bullish score of 9 out of 10 on this one.
And if we connect this to the bigger picture, it really highlights how strategic this company is. It's far beyond just being another chip maker. They aren't just making components. They are, quite literally, building the future infrastructure for every single major tech player on the planet. Their success is tied to the success of the entire global tech economy for the next decade.
That's a powerful point. And it leaves us with one provocative thought for you, the listener, to mull over. Consider that $52 to $56 billion capex budget for 2026. What does it mean for the world when a single company is spending more on capital equipment in 1 year than the GDP of many mid-sized nations? And how fundamentally dependent does that make the rest of the global tech economy on their continued successful execution? That's our deep dive for today. Thank you for joining us as we unpack the finances, the moat, and the massive outlook for this foundational AI player. We'd love to hear your thoughts. Do you see any way for competitors to really challenge them?
We appreciate you trusting us with your time. We'll be back soon with another comprehensive analysis.